Stay like Bloomberg.
23 seconds away from the opening bow this morning. Good morning to you all. Equity futures lower by 0.6%. The labour market data is still okay going into payrolls tomorrow. Nasdaq futures down by 0.75%. Equities down. Guess where yields are? They're pushing higher. There's the opening bow. Take a look at the bond market now. On a 10-year, yields up through most of this morning. Up 8 basis points now on a 10-year to 376.69. Up more so on a 2-year yield. In the FX market, dollar strength off the back of that. Euro dollar 105.50. We're negative 0.5% there. And starting 23 with a bang in the commodity market. WTI down by more than 9% or so in the crude market over the last couple of days. This morning trying to bounce and just about holding on, up 0.4% on WTI, $73 and about 13 cents. About 20 seconds into the session, we're down 0.5% on the S&P. On the Nasdaq, we're down 0.7%. One stock to watch at the open, you know the name, it's Amazon. The tech giant laying off more than 18,000 jobs. The CEO, Andy Jassy, writing in a memo to staff, this year's review has been more difficult given the uncertain economy and that we've hired rapidly over the last several years. Abby has more. Hey, Abby.
Hey, John. Well, one question that is really developing here, I suppose that there are a couple of questions, one of them being what you were talking about before with Richard Bernstein and Chris Harvey, the idea of this strength, the continued strength, solid job market, but with this weakness in tech. But another one is, how do we have some of the world's best management teams having overhired so much? Because, of course, Salesforce yesterday said the same thing, similar to Andy Jassy, talking about the difficult environment, but really that overhiring. It seems as though the Fed liquidity excess ballooned right into some of the best tech management views, that excess, huge growth in hiring, and now Amazon joins the increasing pool of these tech companies cutting 18,000 workers, as you just mentioned, out of jobs from Amazon soon. And they seem to be at the higher level, the corporate level, so probably to help the profit margin. Now, interest rates at 0%, as you were talking about, again, with Richard Bernstein and Chris Harvey in that great conversation. The cost of capital, it seems as though it's even given management teams the idea that there's not so much risk out there. And there's that expansion in the job growth for Amazon over the last roughly 10 years now starting to stabilize. The question is, how much does it come in on those quote-unquote silly investments that 0% can allow for? We will find out as the future goes on, but it's not just online internet pandemic thinking. Take a look at the fact that it's also Salesforce, which that's enterprise software, Uber, and even Cisco, the old school tech company, John, cutting jobs right across. So let's see who else joins this list at this point, but lots of interesting questions arising from this dynamic.
Abby, thank you. That stock is down 0.6%. We'll continue this conversation coming up shortly. Brent Thill of Jefferies, don't miss that in about 10 minutes from now. Retail really feeling the pain. Bed Bath & Beyond coming out with a bankruptcy warning this morning. The stock's down 22%. The stock plunging as the company's recurring losses and negative cash flow cast doubt over its ability to continue. Kaylee has more. Hey, Kaylee.
Hey, John. Yeah, this is absolutely brutal for Bed Bath & Beyond. The actual quote from the statement is that there is substantial doubt of its ability to continue as a going concern. So it is considering a number of options here, including potential asset sales, debt restructuring, reducing business, and yes, ultimately even filing for bankruptcy. But another quote, they said these measures may not be successful. So that is why you are seeing the stock punished so brutally this morning. And of course, Bed Bath & Beyond has been having difficulty with its fundamental business for some time. It has seen 5 consecutive quarters of declining sales growth to the tune of 20% or more. And in all but 6 of the last 28 quarters, same-store sales have deteriorated. They have had a difficult time turning things around. They brought in a new CEO, Stu Gov, after Mark Triton departed, and they're attempting a strategic shift away from some of its private label lines toward national brands. But the problem is a lot of those brands who they want product from actually weren't even willing to supply them because they were so concerned about the financial health of this company and their ability to get paid. Plus the fact that the debt has been trading at distress levels for some time, pretty foreboding signs for this retailer. And all of this is made more interesting, John, by the fact that this was a retail favorite stock, retail traders, that is, a big part of the meme stock boom 2 years ago. At its high in January 2021, it was trading north of $50 a share. This morning, it is south of $2 a share. So this is just a stunning example of the fact that the era of free money is over. The fundamentals matter once again, and the fundamentals for this company, John, are not looking good.
Brutal, ugly. Stocks down 23%. Kaylee, great work as always. Biggest one-day drop going all the way back to August. That just gives you an idea of how tough things have been for this name over the last couple couple of years or so. Looking ahead to earnings season, really kicking off next Friday with JP Morgan. Morgan Stanley's Mike Wilson painting a very ugly picture.
We're going to get a nasty earnings recession. And so the companies that can deliver on the cost efficiency are the ones that are going to continue to perform until you fully price, whatever this downturn on earnings are going to be.
Citi's Kristen Bidley looking for a double-digit downside. She writes the following: corporate earnings are likely to fall 10%. We have not yet seen the impact of the financial tightening on earnings. We will see that in 23. I'm really pleased to say that Kristen joins us right now. Kristen, is it too early to expect to hear those kind of things from some big names from the S&P 500 in the next couple of weeks?
I don't think it's too early. I think we're going to see the start of it within Q4 earnings, and that's going to be a theme throughout 2023. This shift from what was 2022, focusing on inflationary pressures, those companies with durable demand, to being able to pass this through to consumers, to now all of a sudden looking at the impact on growth. And so in 2022, we really only saw maybe two sectors focus on this. It was financials, who talked about loan loss reserves, growing credit card balances, and the retailers. And I think this is going to start to spill into other sectors, which is why we're calling for an earnings contraction of upwards of about 10%.
So what I also hear from you then, Kristen, is you don't think we've seen the lows in this equity market over the last 12 months?
Unfortunately, if you're in the camp that we're going to see a recession, equity markets have never bottomed before a recession has officially begun. We've never seen that throughout history. And so that is something to keep in mind. The other thing, too, is when we talk about what's being priced into markets, I know we're talking about 2022 being an awful year with the S&P 500 being down over 18%. But if we look at the trend over the past 3 years, the S&P 500 was up over 30% in 2019. It was up 18% in 2020 and nearly 30% in 2021. So some of this is mean reversion in terms of the exogenous behavior that we saw in supply chain shocks, in COVID. And so a true recession and a true earnings contraction is not priced in here.
So Kristen, Richard Bernstein was on the program a little bit earlier from RB Advisors in the last 30 minutes or so. And he thinks this index story on the S&P 500 is going to be challenged for quite a while because of the weighting to growth companies, the weightings to these big mega cap tech companies. Do you agree with that then?
I would agree with that. I think the challenge that we have is, we always say don't fight the Fed when there are easy monetary conditions. We have to follow that sage advice when there's tightening financial conditions. All of the data that we're getting, whether it's the commentary out of the Fed or the data around the jobs and employment picture, is telling us that they're going to continue on this tightening path. And so ultimately, I think that is something that we don't want to be in a position where we're investing in companies that are reliant upon very low interest rate environment or don't have the balance sheet or experience or leadership to be able to navigate these tighter financial conditions, which we expect for quite some time.
Well, let's talk about leadership decisions right now. Mark Benioff over at Salesforce, 10% of the workforce is going to go. Andy Jassy over at Amazon, and I'll talk about that a little bit later, 18,000 jobs are going to go. At what point does that start to become good news for some of these names, some of these stocks, and for the industry more broadly that is starting to push harder on costs?
So we saw this about midway through last year, right? That we saw a lot of tech companies start to announce recession plans, start to talk about layoffs. I think the interesting thing when we look at the overall employment picture, though, is you have to say so technology, for example, represents more than 20% of the market capitalization of U.S. equities. However, it's only about 2 to 3% of the labor force. And so when we start to look at areas where we could see substantial job losses, we're actually looking to parts of the economy like residential construction. So housing was a big story in 2022, where you saw new home sales, resales decline by 30-40%. However, when you saw new housing starts, they only declined by a couple of percentage points. This is an area when you're talking about tight financial conditions where you're going to put capital to work, where we expect almost a loss of upwards of about 300 to 500,000 jobs. And so we have to look kind of at the sector and exposure when it comes to the overall labor force as to where we're really going to see that flow through into the job data.
And Kristen, also draw a distinction between what you think is about to happen with the economy and what's happened in the market already. Home builders last year, ugly, almost as soon as we kicked off 2022. So with that in mind, Kristen, can you help me understand where you think there are parts of the market that are further along in the adjustment process where you actually think there might be some opportunity?
I think that ultimately we're still pretty, as I mentioned earlier, we're still pretty defensively positioned. And so that's why we continue to be overweight fixed income. We believe that even within fixed income, we haven't seen credit spreads blow out. So even within our positioning there, we're still invested in quality. We like municipal bonds. We like preferred stocks at this level with financial issuers. And then on the equity side, we're still pretty defensively positioned, John, to be honest. We are looking towards those sectors like healthcare, global pharmaceuticals, those sectors that have been resilient and able to grow their earnings through the past 4 recessions. So healthcare is a great example, an 8% earnings growth. So we're sticking with that playbook.
Kristen, just finally on the bond market, you mentioned that, and excuse me for jumping in, but this move this morning up 12, 13 basis points on the front end on a 2-year to 448, on a 10-year up 8 basis points to 377. Kristen, what do you make of that move this morning off the back of some pretty resilient labour market data in the last 24 hours?
I think we're going to continue to see some of that volatility around the front end, and that just goes back to the market looking for whether there's some dovish signals or some hawkish signals. So that good news in terms of the resiliency and in terms of some of the jobs data is obviously influencing that movement, and basically the market's anticipating a more hawkish message from Powell next Tuesday, and unless we start to see some of the breaks either in a material decline in the trend in inflation or a break in employment, as I mentioned, areas like residential construction, the market is going to anticipate that you're going to still see that strong curve inversion and some pressure on the front end of the curve.
Payroll's coming up tomorrow morning. Kristen, thanks for jumping on with us. Appreciate it as always. Kristen Bidley there on the latest in this market, latest in the bond market. Big moves. Your yield curve, 2s10s, negative 71 basis point. The 2-year up 12 or 13 basis points. The 10-year up by about 8 or 9 off the back of that economic data earlier. The equity market 10 or 11 minutes into the session down by more than 1% now on the S&P. On the Nasdaq down by 1.4%. Coming up, Amazon joining the growing list of tech companies cutting jobs.
The big challenge for Amazon in the third quarter wasn't that their e-commerce was slowing. It was that their higher margin, higher growth cloud computing and advertising business were starting to feel the negative impact of a challenging macroeconomic environment.
That conversation up next with Brent Thill of Jefferies.
The big challenge for Amazon in the third quarter wasn't that their e-commerce was slowing. It was that their higher margin, higher growth cloud computing and advertising business were starting to feel the negative impact of a challenging macroeconomic environment. So to the extent that you continue to see more weakness, then 10,000 could become 18,000, could become 30,000. We'll see how they continue to manage costs.
Another sign that the tech slump is getting worse. Amazon slashing more than 18,000 jobs in a cutback aimed at the corporate ranks. Brent Thill of Jefferies keeping his buy rating on the stock with a 135 price target. Brent, I'm pleased to say, joined us right now. Brent, fantastic to catch up with you, sir. It's been a while. Let's just start with this, and it's a question that I think has come across my desk, maybe yours, several times over the last 24 hours. It's a company of 1.5 million people. 18,000 jobs doesn't sound like a lot. It's not a lot. Why is this significant?
Well, I think it's a step in the right direction. To your point, it's a rounding error. It really doesn't have a meaningful impact. On a corporate side, obviously their corporate headcount is a lot lower. So maybe 1% of the overall headcount, but maybe closer to 4 to 5% of corporate headcount reduction. So if you look at Salesforce.com, Elastic, number of software companies, they're laying off 10 to 15% of their headcount. So it's been pretty consistent across tech. So this isn't shocking. The magnitude should probably be higher. It may end up being higher. Jefferies is forecasting a more prolonged recession and a later start to the recession, which is bad news, meaning this just gets dragged out potentially even into 24. So that is the scary news of this whole thing, that this is probably the tip of potential layoffs in the tech industry. We've seen, again, a pretty massive hit to the industry. But I think based on what we're seeing, and our economists are predicting, that this may end up being continued bad news, at least through the first half of 23.
So, Brent, this is super difficult to do, I know, but what kind of numbers are you thinking about? This is a company that added, what, 1 million jobs over 3 years or something like that? What kind of numbers reductions do you think are in store here?
I mean, it's hard to say, a company with 1.5 million employees, they've said this, that they have overbuilt capacity in a massive way. And I think I go back to Andy Jassy is a software individual. Software individuals believe in high margin recurring revenue. They don't believe in taking risky bets all over the place. I think it's in his core DNA, in my opinion, having talked to him, that as a software investor for the last 20 years, I believe he believes in high recurring, high visible, high revenue revenue streams. And so if you believe that, I would expect he's going to take harder action on things like hardware, on lower margin products, and shift back to AWS and all the other categories that are producing incredible, profitable returns, and away from flying drones and away from all the experimental things that they've done. Yes, they want to innovate. Yes, they want to stay in the bleeding edge of building interesting technology. But I do think that maybe perhaps what happens here, especially with his arrival, is he leans back into these other businesses. So I think you're going to see the lower margin businesses get hit harder, and the higher businesses be less impacted. But clearly, all the high margin businesses of advertising cloud are under duress too. So I expect, again, I don't think this is the last cut across tech. I don't think it's the last cut at Amazon. And even if you look at Salesforce.com's cuts yesterday, they were pretty clear that this may not be the last one, that this is going to be a theme of producing good growth with profitability. Tech has been in a mode of just growing at any cost, and that game is over. It is about doing it in a responsible, profitable way. Investors won't tolerate it going forward. And so that just means there's going to effectively have to be more expense trims. It may not be headcount reduction, but it may be things around stores, warehouses, additional capacity that they're building out, we may see the cut there as well.
So, Brent, there's two things going on here. We've got the discipline of 4% interest rates on one side, and then on top of that, Brent, I can hear that you and the team are wrestling with this cyclical test that these tech companies are going to face, maybe in a way that they haven't in a long, long time, and for some names, if ever. Brent, can you put some numbers on it and help me understand what that's going to do to, say, growth in e-commerce, and even for AWS going forward from here?
I think the consumer's weaker. You're seeing this, and that's going to have an impact on items. We're still going to buy basic goods for our house from Amazon, but effectively buying the $400 Lego set or buying, all the other things that maybe are not necessarily required. We're going back to a must-have versus want-to-have. And so I think that's going to put weight on the consumer. I think you're seeing this across the board. We lowered our numbers on AWS and on Azure this morning. Mega cloud hyperscaler growth is slowing. Advertising growth is going to slow because the first thing that companies do in an economic recession is turn their advertising dollars off. So I think again, this is across tech. In the front half of the year, we're in for another reset of numbers, and hopefully we get reset enough so that we can actually start to create a bottom. I think we've cut numbers 6 or 7 times on Amazon. We haven't raised numbers in a year and a half. And again, part of this is created because of the pandemic. The pandemic created such a pull forward that you're digesting this pandemic pull forward, and then unfortunately that pull forward then ends up meaning a recession, which is a double whammy.
Yeah.
And that's the hard thing right now.
So Brent, here's the bigger challenge, and forgive me for jumping in. It's 135. 135 as a price target is what, 60% upside from here, and you talked about maybe things going better in the second half. Brent, they need to be a little bit better than that, don't they? They need to be great to get to 135. How do we get there?
Yeah, I mean, tech investors have to take a multi-year view right now. The economy is getting worse. Again, we're potentially going into a recession. And so what we've said is, is that tactically we've been very bearish on tech, but these are phenomenal, great franchises, and this is a great opportunity for longer-term investors. We're going to come out of this. The question is it 2024 or is it 2025? And ultimately, again, our house view is that this recession starts later and potentially longer. That is scary. And from that perspective, again, Nadella said this in Microsoft yesterday to an Indian news outlet that it could be 2 years before the next tech boom. And that's Nadella, who's the most honest, upfront person on the planet. So that to me, again, you have to take that into context, is for long-term investors, these are incredible franchises. Amazon's durability and franchise and AWS, they are the 800-pound gorilla, and no one's even close to them in cloud computing. I mean, Google and Microsoft market share combined, there's $15 billion of delta between the two combined market share. Amazon's so far ahead. So this is a great long-term franchise. But again, I think we have to stick with our clients are in energy, healthcare, auto equities, in other vehicles, and that's okay. And so, like, the storm's coming through. I'm in San Francisco. There's a storm coming through San Francisco right now. Hunker down. Don't try to fight it. And I think that's the advice we've been saying is don't fight it in the front half. Let the numbers come down. Let the companies cut the numbers. They haven't been in front of the puck. They need to get in front of the puck, and they need to cut numbers and cut headcount more. Once they do that, you've cleared the deck. Multiples have compressed. So the good news is all the multiple compression is in. A lot of these multiples have been severely impaired. And so we need the companies to cut. We need us to stop talking about how bad it is and the companies to say how bad it is.
Yep.
And then investors will come back. But until they do that, they're not coming back into the tech pond.
Hey Brent, it's a super difficult moment. And by the way, stay safe on the West Coast as well. Brent Thill, been too long. It's great to catch up. What a difficult moment for some of these names. Coming up, your trading diary from New York. This is Bloomberg. Sometimes it's pretty straightforward. The economic data is good. The Fed's telling you they're going to do more. Yields are up. Stocks are down by 1% on the S&P. On the Nasdaq, we're down by 1.2. That's the price action. Let's get you the trading diary. Coming up, President Biden speaking at 11:15 Eastern Time. The House reconvening at noon. Fed President Jim Bullard speaking shortly after, 1 p.m. Eastern, followed by Cook, Barkin, Bostic and George, all speaking on Friday. And on Friday, of course, is the main event. It's Payrolls Friday, just around the corner. Looking for something in and around 200K on payrolls. Special coverage, as always, right here on Bloomberg coming up tomorrow morning. From New York City, thank you for choosing Bloomberg TV. As always, this was the countdown to the open. I'll see you tomorrow morning. This is Bloomberg.
Experts, great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, January 5th. Here are the top market stories we're following for you at this hour. Growth by 1,000 job cuts. Amazon laying off 18,000 workers. The latest tech company to slash headcount. That stock down over 2%. Whoops. We still got jobs. Private U.S. companies hiring over 230,000 workers last month as the tight labor market stays a thorn in the Fed's side. Equities roll over and yields pop. And IG market parties like it's 2021. The borrowing blitz continues for a third day. Levels not seen for years. We're going to get the trade from Mark Okada of Sycamore Tree Capital Partners. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And Guy, the Fed spigot opens yet again. We heard from Bostic earlier this morning talking about a lot more work to do to tame inflation. Neil Kashkari yesterday. Esther George also saying that she's looking at terminal rate above 5%. This is coming. More hikes are coming. Markets may be believing.
Yeah, and the reason the markets are believing is because they're looking at the labour market, which is interesting because we've got kind of two stories in the labour market today, haven't we? We've got the Amazon story on one hand, and we've got the claims data, the JOLTS data yesterday, the ADP data today, and of course the payroll number tomorrow.
Yeah.
The data thus far on the labour market has been strong if you strip out tech.
Right, exactly. And also you have to wonder where those jobs wind up going in tech. Are they all based in the U.S.? For the big multinationals, Are they going to be spread out? So that might also distort the data. Typically, though, if you wind up getting serious about cost cutting, your stock rallies. Look what happened with Salesforce yesterday. For Amazon today, that isn't happening.
It's interesting, isn't it? You're getting a different reaction, which makes you wonder whether or not you should think about these layoffs differently. Has Amazon got more of a structural problem? I think we probably all got a little overexcited about e-commerce during the pandemic. There was an expectation that that would continue. Maybe the baseline for e-commerce going forward is a little lower than we anticipated. If you take a look at what happened with Salesforce yesterday, short-term headwinds, long-term structural growth looks still very strong. So you're getting different reactions for different stocks, and I think that is significant. People are beginning to segment what is happening in the tech space. But I think the question that we've been asking throughout the day on all our meetings and trying to work out how we're going to kind of position the show is, do you sell any rally in tech? If you see an opportunity, if you see some of these big name tech stocks rallying, is that an opportunity to get out rather than get in? Joining us now to discuss this, Bloomberg Intelligence Chief Equity Strategist Gina Martin Adams and Anurag Rama, also joining us from Bloomberg Intelligence. Anurag, let me start with you. How should we think about the job cuts that we're seeing right now? Because I want to kind of set this up so that we then understand whether we buy or sell. How should we be seeing these job cuts? Are they an opportunity to kind of fix the middle of the P&L, to improve margins, to right-size a business, therefore it can continue to grow? Or is this something more structural happening here that we should worry about?
So I think you put it very right. There are two buckets you want to look at. When it comes to a pure technology company, enterprise tech spending, the likes of Salesforce, what they're doing basically right now is they're looking at the demand right now and seeing that there will be a slowdown in tech spending throughout 2023, and they're rationalizing their portfolio. Now, in the case of Amazon, it's a different animal. It is a retail, more of a retail bias. So I think, you put it well over there are two different buckets. But from our side, when we look at tech companies, shedding jobs, it's more or less just to rationalize their cost structure based on the current demand environment.
So, Gina, typically, though, these tech companies do well in a growth environment. They're growth stocks. And I appreciate that they want to focus on margins or profitability, or they got over their skis during the pandemic or whatever. But can you cut jobs and also be a growth stock?
You can cut jobs into some form of earnings prosperity. I think the other thing that we're not discussing is what are we valuing in these stocks, frankly, and I think that that's probably the bigger story still is when rates are going higher, we're still adjusting to higher rates in the valuations, and the multiples of these stocks are all still well above where they were the last time rates were even at these levels. So if the Fed is going to continue increasing interest rates, the value of that future earnings stream is less, frankly, and we're still in that adjustment process. We've gone a long way through that adjustment process through 2022, but our work would suggest with this group trading a standard deviation above its long-term average premium to the S&P 500, we're still not accurately valuing rates. And I think that that's going to continue to plague this space, frankly.
Gina, are we still in danger as well of looking too much at the top line versus the bottom line? As rates go higher, I'm presuming we need to think more about profitability rather than revenue.
Yeah, I do think we need to think about profitability rather than revenue. I think that you are starting to think a little bit about revenue, though, this year. I mean, it's been a profitability story for most of the last year because it's very difficult to get a read-through on revenue in an environment of inflation throughout the broad index. But we're starting to think about revenue. Analysts have been marking down their expectations for margin growth throughout 2022. Now they're starting to mark down their expectations for revenue growth for the index at large. This is also a tech-specific story
story when we look at tech, communication services, as well as the tech stocks embedded within the consumer discretionary sector. We are seeing pretty material revenue growth deceleration, which is really taking the wind out of the sails of that long-term structural growth story to some extent. I do think, though, that margins will be a very big key to watch. I mean, you generally, at this stage of the cycle, see stocks bottom when margins bottom, not when revenue growth expectations bottom. It's about margins leading the way out, and I do think you want to watch that very carefully in the upcoming earnings season.
Okay, so Anurag, to that point, when you talked about this is not necessarily a crazy thing to see in tech companies in this environment, when you say this environment, is it because, Anurag, we're expecting deterioration because of the economic growth cycle, or is this a story of huge expansion during COVID and now we're just right-sizing? Because those say two different things.
Yeah, no, I think it is a demand destruction because of the economic slowdown. We have seen massive tech spending over the past 6-7 years. Now this is the year where tech spending is going to be probably the weakest we have seen in a very long period of time. And now what happens is you look at even the top of the best of the companies are not going to be able to grow as much as they did last few years. And I think, valuations, as Gina rightly said, as rates continue to go up, their valuation is going to compress because now we are, getting hit both by the discount rate as well as growth expectations coming down.
Anurag, how different is the operating environment, the investing environment going to be going forward from here versus where it was over the last few years? Are we going back to the last few years, or are we going to something new in which we need to think about growth, we need to think about tech differently?
I think the answer to that is where does long growth rates settle in? I think it all depends on the rates more than anything else, frankly, because, from our side of view is that if tech spending slows down, whatever it slows down to this year, there will be a bounce back once we get into a normalized economic environment, because this is not something that was just a pandemic-driven thing. This is structural issues about companies becoming more digital. So I'm not concerned about tech spending in general in the long run, but I am concerned about where does the long bond or the long rates settle in, because that really dictates the valuations of all these tech companies.
When the tech guy looks at the long end of the bond market, I mean, I feel like that says something in our world. So Gina, last question to you, which pivots off of that. What's leading what? I'm just looking at the dollar, seeing a really nice jump right now. Yields really popping. Is it the equity story, the margin story, the profitability story that's going to be leading markets, or is it still going to be the macro part that's going to lead equities?
Oh, I think it is and always will be all about the Fed, and the Fed is about the macro. I think that earnings always play a part in the long-term outlook for stocks, and are certainly important, particularly consequential during earnings seasons. But frankly, we've been in an environment with such very vicious rate increases over the last year that it's compressed valuations over the course of 1 year, what took 3 years to do in the compressing in valuations of the tech bubble. That says a lot about how sensitive the market is to rate increases, the future pace of rate increases. We've all lived through the last 6 months in which stocks rally every time. We think the Fed is going to slow down the pace of rate increases and then suddenly capitulate on the idea that the Fed is still attacking inflation. So it really is about rates with earnings as a sideshow.
Earnings a sideshow. And can Gina say that?
Wow.
Is that like a legal thing as an equity?
Can we cut that sound? I can't believe that Gina Martin Adams has just said those words. I'm sorry, I'm in slight amount of a shock here.
Yeah, okay, Gina's like, I'm going on vacay. All right, guys, thanks a lot, Anurag and Gina. Thanks very much. Appreciate it joining us from Bloomberg Intelligence. So coming up, more on the question of the day. Now the question feels like, are earnings a sideshow? But it is, do you sell any rally in tech? Cameron Dawson of New Edge will be joining us next. This is Bloomberg.
It's the first jobs report of the new year.
The labor market has not cracked.
A lot of that's a function of labor shortages.
Tomorrow, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Can you walk us through how the Federal Reserve conversation has reset?
We're still seeing a strong economy, so the Fed has to do more.
Why are people so confident that there is going to be some massive deceleration?
I just don't see the evidence. This could go a lot of different ways.
The December jobs report, tomorrow on Bloomberg Television and Radio.
Depending on where you look in the economy, you can kind of tell yourself whatever story you want. Oh, the labor market's very strong. The economy's not going to dip into recession. But look at the interest rate sensitive sectors. They've completely rolled over because of what the Fed has done. I mean, that really is going to be the question. And I think, taking a step back when we think about the distribution of outcomes, to your point, it's not as binary as a lot of people believe it to be. It doesn't need to be black or white. It doesn't need to be growth or no growth. It could arguably be an environment where we muddle through and perhaps we don't see that maximum downside that has become very consensus to go out there and espouse.
All right, we got some breaking news for you. The Kremlin is saying that Vladimir Putin has ordered January 6th and 7th as a ceasefire in Ukraine. Again, the Kremlin saying that Putin has ordered a ceasefire in Ukraine from January 6th to January 7th. One off days necessarily isn't anything unusual. We saw that for Christmas Day, for example. IFX have reported that Putin was also declaring a truce at that point. But this does come after a brutal shelling of Russian soldiers in certain areas of Ukraine. Guy, you have to wonder if there is a longer-term ceasefire, how that is or isn't priced into the market and what kind of upside risk at that point.
Getting a little pop in stocks right now on the back of this. You can see that in the Dow. You can see that in the Stock 600 right now. We're beginning certainly to move to the upside, well off the lows. So it'll be interesting to see how markets react over the next few minutes to this news. Clearly, there is a kind of holiday element to all of this, which I think we just need to be aware of as well. We are still kind of coming through the Orthodox Christmas, and we need to be aware that there is that. So be careful maybe reading too much into this necessarily. Yeah. Nevertheless, we have seen also the Turkish president, Mr. Erdogan, urging such a development. Yeah. Whether it gets taken further, I don't know, but I think you've just got to be aware of the calendar around all of this as well. Yes, it appears, if I'm not mistaken, January 6th would be considered Christmas Eve in Russia. So, yeah, in essence, that wouldn't necessarily be too much of a surprise. But nonetheless, you see a headline like that, and it's something. Mark Sorcian of Bloomberg joins us now on this. Mark, hey, we appreciate you hustling on this news. Okay, so the news, the Kremlin is ordering, or the Kremlin says that Putin has ordered January 6th to 7th ceasefire in Ukraine. Can you walk us through the significance?
Yes, I mean, obviously we don't know a great deal right now, just literally that. And if that's all it is, it probably doesn't have much significance at all in terms of just sort of, battlefield, other than on the day perhaps, and in terms of battlefield intentions and so on. It seems, it's likely, this was actually foreshadowed by President Erdogan in Turkey, who suggested earlier that Moscow should order a unilateral ceasefire. This is now seems to have taken place in the sense that, it's a one-day ceasefire over Christmas. But it's if that's what it is, it's largely a gesture. If you think of previous wars, like in the war in Yugoslavia, there were dozens of ceasefires of this kind.
Is it, though, an indication, Mark, maybe of Vladimir Putin's awareness of sort of domestic forces that are becoming increasingly concerned? This follows, obviously, the attack on the barracks, which have killed numerous Russian soldiers. That has caused consternation within Russia. Is it a recognition, maybe, by Vladimir Putin of the increasing concern that is growing domestically?
Well, there's no question there is increasing concern. Mostly that concern is over the competence of the conduct of the war, though. This would appear, at least on the face of it, more to be a signaling that that Russia is willing to talk, that Russia is a reasonable actor, and that it isn't just the warmonger. At home, most of the pressure coming on Putin is about the competence of the war and of the war effort, and not so much that the war itself is unpopular. So, it's not quite clear how a one-day Christmas ceasefire would help him in that sense.
Yeah, fair enough. And as we pointed out, that's Christmas, so 24-hour ceasefire for Christmas, for example. But can we go back to the Turkey conversation here and President Erdogan trying to lay that groundwork for peace talks? Realistically, how successful has Erdogan been, and what is the relationship between the three, Zelensky, Erdogan, and Putin, in terms of getting to the table?
Right. I mean, that's a very good question. Turkey has been surprisingly successful in organizing or brokering the grain deal that has enabled grain to be shipped out of Ukraine, which was incredibly important for food prices worldwide. So that was an enormous achievement. He has also tried, simultaneously to develop ceasefire talks, peace talks. Those have gone nowhere, essentially. So, whether this signals that, Putin is now willing to wants to start discussing peace, or whether, that's not clear. It's definitely not clear that he'd be willing to make the kinds of concessions that would be needed to make that successful.
Okay, Mark, bottom line, is there a danger that we read too much into this? This, as you've indicated, is something that is being done for Christmas. It's a very brief period of time, and it looks like hostilities are going to continue as they were once this ceasefire has passed. How much should you, therefore, as investors, should we read into what is happening here?
I think we should be very careful indeed. So, there's all that we know at the moment is that there's a one-day ceasefire, which is, if that's all it is, it's essentially meaningless. However, it could indicate something further. It's just that we have no data on which to try and, figure that out. So, we'll have to wait and see as to whether this is actually, a first move to indicate a greater willingness to make concessions. I would say not to have a ceasefire, because a ceasefire on the current lines would be very much in Russia's interest, and they would, want to have that. It would not be in Ukraine's interest, and that's why it's unlikely to happen unless President Putin is ready to negotiate.
Mark, thank you very much indeed for updating us and giving us kind of the context around this headline. We really appreciate it. Bloomberg's Mark Champion on the headline that we've seen over the last few minutes, that there will be a Orthodox Christmas holiday ceasefire that the Russians are calling in the war in Ukraine. Joining us now, Cameron Dawson, New Edge Wealth Chief Investment Officer. Cameron, I was going to ask you a first question about the tech story, but let me just quickly ask you a quick question about what is happening in Ukraine. It was the big kind of variable in 2022. How does it fit in terms of the landscape that you're thinking about from an investment perspective in 2023?
Well, I think it was the big variable in the first half of 2022. But in the back half of 2022, we saw a round trip of all of the gains in the commodity market. So we really didn't see that inflationary driver from higher commodity prices that could be tied back to the war in Ukraine in the second half of 22. So I don't know if any kind of more lasting ceasefire would really help on that front. I think the biggest impact to global markets would likely be in Europe to see the most benefit from more lasting peace there, simply because there would be more confidence about energy security and maybe more risk on taking within European markets. But I don't think that the impact to the U.S. is that meaningful at this point.
Yeah, Cameron, it does feed in, though, to what's been working and what's not been working, right? Like tech kind of falling out of bed, and then you have energy performing really well last year. Does that kind of trade continue? I mean, when you have all the cost cutting, is that something you want to be playing when it comes to tech?
I don't think that the cost cutting alone is enough to create a bullish case for tech, because we think that there's still plenty of pressure on the earnings for tech. The reason they're having to do cost cutting is because they not only pulled forward demand, but they pulled forward spending. So there's likely a fair amount of margin pressure that we'll see emerge within the tech space. But we still think that there's plenty of pressure on valuations that can still happen in tech. Tech still trades at a 20% premium to the market. And back before the Fed really embarked on this last easing cycle, which started in late 2018 and ran through 2021, prior to that, tech traded just in line with the market. So that 20% premium still looks too high given where Fed liquidity is and also given where interest rates are.
So if you got a rally now in tech, would you sell it?
Tactically, yes. We're neutral tech because in the event that you do see some kind of big deterioration within the economy and the Fed pivots, we don't want to be meaningfully underweight tech as such a big sector. But we have been looking at areas to be able to trim in the event we do see a rally. I think from a technical perspective, tech remains in a very distinct downtrend, which means that when you do see rallies and downtrends, you're better off being a seller into strength than trying to chase those on some kind of emerging trend change. We really don't see any signs of that yet, which means that at the margin, we would be wanting to trim tech.
So then what do you do with energy if you flip it? That's been the winner from last year, for example. What do you do this year?
I think we have to lower our expectations for energy going into 2023. So 2022 was all about absolute upside. But 2023, we don't think that we can have that same degree of upside. It's important to note that energy stocks outperformed the worst performing sector in communication services by 100% in 22. And they also outgrew earnings by nearly 200% of the worst performing earnings sector, which was financials last year. So that kind of degree of outperformance we don't think is repeatable, but we think that having an overweight to energy still makes sense simply as a hedge against rising inflation. If oil prices climb, if gas prices climb, inflation expectations climb, keeps the Fed really tight, so other parts of the portfolio could struggle. So having energy as a hedge there seems to make a lot of sense.
Cameron, what's cheap right now? If you would have a conviction trade, what is it?
So we do think that the broad market is cheaper than the, meaning the equal weight index of the market is trading below its long run average compared to the cap weighted index. We've been wanting to avoid being in the largest names within the index and really preferring that equal weight. And it's one of the areas that we can see that we are trading below average. Of course, international stocks are also cheap, but valuation is not a catalyst for those names. We think we need to see a meaningful breakdown in the dollar for us to really want to step in and go overweight and benefit from that cheaper valuation. But the dollar has fallen in the last quarter. It fell back to its 50-week moving average, has found support. So we do think that we have to be really sensitive to which way the dollar breaks before we would want to go into larger positions in those cheap international names.
Cameron, if we go full circle on this conversation, though, it does feel like the risks this year are actually to the upside. There is so much pessimism. There is so much concern. You are seeing some call buying now coming in. It's like if anything happens, it's going to be a huge rally to the upside. Do you subscribe to that point of view?
Well, I think in the very short term, we don't necessarily have the same setup for a big face-ripping upside rally like we had back in October or June. Whether you're looking at positioning or you're looking at technicals, things like breadth indicators are being oversold, we're not quite at that true flushed out period where things are so bad that they're good that we can be set up for a big shorter term rally. But I don't necessarily think that all sentiment is pessimistic. We really haven't seen the big cuts to earnings that would say we have a low bar for earnings growth this year. Valuations are just average. They're not blown out to the downside in equity markets. And if we look at the bond market, it's pricing in cuts into the back half of next year, which means that the Fed would really have to deliver in order for financial conditions to incrementally ease, deliver on those cuts. So we would think that there's still room for downside surprises in this market.
Cameron, it's going to be an interesting year. I suspect there are a few bumps along the road. we will look forward to speaking to you next time. Let's see what happens. Karen Dawson, New Edge Wealth Chief Investment Officer, thank you very much indeed. We should probably just recap the news that we've had over the last few minutes. Vladimir Putin, the Russian president, calling a ceasefire for the Russian Orthodox Christmas. He has been pushed to do so by the Turkish president, also by the Orthodox Church. Alex, the market reaction fairly muted.
Yeah, I should point out we are still right around the lows of the session. The S&P is off 1 full percentage point, NASDAQ 100 up by 1.2%. This feels very much of a job story. If we learned anything from the minutes yesterday from the Fed, it's that the jobs and the tightness there is going to be the focus going forward as that feeds through into wages. And then you get that ADP number, super strong. Claims, still falling. That feels like a recipe of disaster then it comes to the equity market. Anyway, we're going to break that down. We're going to take a look at the credit market as well. What kind of recession might we see? This is Bloomberg. All right, we're about an hour into the trading session here in the U.S. Bloomberg's Abigail Doolittle tracking those moves around the lows right now.
Yes, stocks taking a tumble here, and the reason's right on the bottom of this board. So take a look at the S&P 500, down 0.9%, to Alex's point, right around the lows. The NASDAQ 100 feeling it just a little bit more, down 1%. It has everything to do with the fact that you have yields higher and the Bloomberg Dollar Index higher, pressuring stocks, bringing into the idea that valuation does matter, liquidity coming out of the system. Why are the dollar and yields higher? Let's take a look at the eco data, because we're seeing some good news, but we're in this strange time period where the Fed is hiking, taking liquidity out of the system and raising rates, and that means that good news is actually bad news because it keeps them on that path, because the economy is doing relatively fine. So you have the ADP jobs added above. You have the jobless claims today lower than expected, continuing claims coming in better than expected, the monthly trade rate balance just a little bit better, and then the services PMI. Now, I would argue, yes, a little bit of a beat there, but it's still 44.7, well below the contraction level. So that's actually not such good news. But net, this is not an economy in recession yet. So it gives the Fed leeway to hike, and that, of course, can, again, pressure stocks. Relative to the reaction in the bond market, it's pretty significant. The 2-year yield is popping sharply higher. Take a look at this, and it's up about 12% or so right now. The best or the biggest move, or not 12%, 12 basis points, the biggest move in quite some time as investors. These bond traders just keep getting caught off sides, Guy. And then if we very quickly take a look at some of the movers on the day, it's significant because Bed Bath & Beyond, all you have to say is going concern risk. Constellation, a little bit of a rough view there. Walgreens, also a rough profit view. And there's Amazon cutting 18,000 jobs. Some folks saying that's just the beginning, that some of these tech layoffs are just going to continue. That stock not reacting well, not exactly the reaction that you would expect for a stock that was down 50% last year, the worst year since 2000.
Yeah, I think it's kind of this long-term e-commerce story that I think maybe this flags and the concern around it. Abigail, thank you very much indeed. I think our next guest would take 12% on the 2-year, though. U.S. investment-grade bond market certainly kicking off in 2023 as well with a rush of new offerings. We should talk about that too. Companies definitely taking advantage of what is turning out to be a very favorable market window to get ahead of course, a possible recession, which could come a little later this year. Mark Okada, Sycamore Capital Tree Partners co-founder and CEO, joins us now. Sycamore, of course, an investment firm and asset manager specializing in private and alternative credit. Great to see you. Happy New Year, Mark. We'll talk maybe about 12% on a 2-year a little later on in the conversation. But let's discuss the start of the year. People I'm talking to in credit are talking about an incredible few days. Yesterday in particular, in terms of investment grade issuance. What do you read into this?
I think it makes a lot of sense. I mean, predicting the future is always a waste of time, but preparing for it makes sense. So if I were an IG company and the markets were open here and rates are going higher, why not issue as many bonds as possible now?
Okay, market stays open.
Right.
How long does it stay open if we're headed for Fed funds rate over 5%?
So Alex, we're talking about IG, which is quality. Quality yield right now is quite a great place to be. I mean, if you can think about where the whole rest of the world is as far as valuation and things we're worried about. Investment-grade corporates at a discount, I think the index is somewhere around high 80s as far as the dollar price, and you're getting 5-something. That's not a bad place to invest money. And if you can make 5-6% doing that, why not? Versus owning the S&P or owning a lot of the other things. That alternative in credit is a nice place to be. And I think that's why money is flowing into that market. I think it's open. I think that's going to be a pretty durable investment strategy for quite a while.
But it is only IG.
Yeah.
You take a look at what is happening with junk, you take a look at what is happening with leverage loans. I'm not seeing much action there at all. Is that going to be the story of this year?
Well, it's challenging because we're all getting ready for a recession, Guy. And I think when you think about recession and you think about the scale and the size of the markets we're all dealing with, it's pretty unprecedented. And the last time we had a real sort of cycle, I would say a real cycle is not like we had in GFC where just everybody's selling everything. It's where your fundamentals don't match what your balance sheet is set up for. That was 99 to 01. That was a long period. And so you've got to get set up for a two-year sort of workout minimum. And so it's going to be choppy for a couple of years. And I think if that's your outlook or your focus and your preparation, then when you're looking at a new issue market, it's hard to get excited about a lot of things unless they're coming at 9-10%. And some of that's going to be interesting.
Where might that be interesting and where is that too risky?
So the index isn't your friend right now, Alex. I mean, it isn't. It looks cheap, right? High yield doesn't bottom at a spread per se. High yield bottoms at a dollar price. And so if we're at 87 on high yield bonds, it's getting there. It's getting closer. Spread doesn't look anywhere close to recession. But when you peel back the onion on the indices, there's a lot of things in there you don't want to own. There's just a lot of companies, but higher quality within that space, higher quality credit is a great buy.
Is that going to be sector or is it really company by company?
It's going to be both. So let's take the largest sectors like tech and communications. There's going to be companies in there that have solid business plans. They're maybe overvalued. So it's probably an equity problem, not a debt problem specifically. But, you know, some of that stuff is selling off with the rest of it. And like we constructed a nice portfolio of loans and bonds, and we're making 9%. 9% is pretty good. I mean, I think we're getting paid amply for the risk. Now, there's definitely risk. I mean, but that's kind of what we get paid to do, is just find places where we think we're getting overpaid for the risk, and some of that does exist given, you know, where the setup is here going into probably a recession. At least that's what everyone's predicting, right?
Okay. Well, 9% compares quite nicely to the 12% on the 2-year.
No, it doesn't.
Talk to me a little bit about liquidity. The Fed's sucking it out. Do I want to stick to deep pools?
I think liquidity is always something to worry about. You know, we saw this gilt crisis that happened last year, and the response was appropriate. I think the idea of monetary policy having two different tools, one being the balance sheet, quantitative easing or tightening, and the other is rates. I don't think they blink at all on rates, but I think there's going to be times when the Fed's going to have to stop QT and, you know, react to that liquidity mechanism. You know, seeing the 2-year back up 12% basis